Go. Well, welcome back. We'll continue the rest of the Board of Investments meeting. We're at tab 5, short-term investment pool. And so this is a good chance to learn about that and ask questions. So I'll turn it over to Kristen, and good luck.
Great, thank you. Good afternoon, Chairman, members of the board. The fixed income team is going to wow you with our deep dive on the short-term investment pool, or STIP as we usually refer to it. I'm Kristen Haswell. I just finished my 5th year as the primary manager of STIP. And with me today presenting, I have Sam Holman and Willie Gross, hopefully, who are our 2 fixed income investment analysts on the team. And they are also, as an analyst, the primary backups for STIP as well. Start on page 2 here. Start by saying kind of what is STIP. STIP is managed similar to a money market fund. You talked about fees earlier, much cheaper than some of the other ones out there in the market as well. Doing so, it's not just the cash pension asset class, but also all the state agencies use it as their cash vehicle. The Treasurer's Fund uses it as their cash vehicle. And something that is unique to Montana is we allow our local governments to invest in STIP. So there's a large variety of STIP clients, but they do all have similar goals when it comes to their investment in STIP. They want to transact at $1 and they want to earn income. So our strategic objectives are safety first, liquidity second, and income third. Moving on to page 3, we'll start talking about risk. STIP is currently over $8 billion. It means it's a really large pool of money. Last calendar year, we had over 1,300 transactions in excess of $51 billion. And so that's not just work for the fixed income team. Our operations team has to approve all of those trades. Our accounting team has to book all of those transactions. We couldn't run effectively without them. So I always like to give them a shout out here to say, thank you for all their hard work here. At the end of the year, the STIP reserve was 93 basis points of the STIP balance. We expect to reach our goal of 1.15% in the next 12 to 18 months. Yes, I said that last time I talked to you all, but that was when the expected balance of STIP was supposed to go down. It hasn't, it came up, 5 years ago when I started, it was 3.5 billion.
You're shooting for 1.65% of the STIP balance in reserves?
1.15, yes. Mm-hmm.
How'd you come up with 1.15?
John Ramasco, our director of fixed income, ran a bunch of stress analysis testing based on worst market scenarios, and that's where we came up with that 1.15.
We did that kind of the post GFC numbers that we had, 07. So,
And it's been building over that period of time.
Mm-hmm. Yeah.
Can I ask another question?
Sure.
I'm sorry.
That's fine.
Earnings off of STIP go to the participants, or do they go to the general fund, or depends on, it could be a general fund STIP too, right?
Yes,
But it goes to the participant.
it's the participants, yeah. And we'll talk about the earnings later in this presentation as well. But right now I'm going to hand it off to Sam so she can talk about the various risks that are interrelated in STIP.
Thanks, Kirsten, and good afternoon, members of the board. She mentioned I'm going to go over some of the different risks that we deal with in STIP. There are 4 primary risks that I'm going to cover. Those are credit risk, market risk, liquidity risk, and interest rate risk. So number 1, credit risk. Credit risk is the risk that an issuer underperforms and as a result are not able to repay their debt. There are various factors that can impact this, including the company's creditworthiness, financial health, other economic conditions, and so forth. We manage this primarily by maintaining a list of approved names that we review regularly. To make it onto the list, there's a set of requirements, both set in policy and then also that we set as a team. And each name has to meet certain levels on those requirements to get added to the list. And to add a name to the list, we discuss it as a team and with risk management. And once we all agree, we can add it to the list. If somebody wants to remove a name from the list, though, only one person is required. If somebody's uncomfortable with a name, they can take it off. A recent example of this was a month ago or so, Archer Daniels. There was a headline about them, and they were being investigated for their accounting practices. Kirsten saw it and just immediately took them off our list and limited our exposure there. So another way to mitigate our credit risk, in addition to our approved list, is just maintaining a diversified portfolio. On slide 5, you can kind of see the different sectors we're in. And then, yeah, that's about it for credit risk. I'll just mention the chart below shows the relationship between commercial paper and similar length T-bills. It's a reflection of how risky the CP is viewed to comparison compared to T-bills. All right. Moving on to number 2, market risk. Market risk is the possibility of losses due to macro trends that cause fluctuations in financial markets. Say the most recent and prevalent example of this would be the Federal Reserve's policy on the Fed funds rate and the hiking cycle that we've been hearing about, and the following impact on the markets. Similar to credit risk, we have some strategies that we use, such as diversification and minimum credit quality requirements that we use to mitigate this. Additionally, we utilize maturity caps. So for example, we're only allowed to invest up to 90 days long in ABCP in our asset-backed commercial paper, and different asset types have different maturity caps.
So I know there's a whole variety of those caps.
Mm-hmm.
Is there any of those that make it hard for you to do the job, or would you come to us to say we want to change those, and then is there any that you would think that maybe we should change or make tougher so you're not concentrating on anything?
Yeah, I might defer to Kirsten on this, but I'm comfortable with them. We do bump up against some of the caps occasionally, but I think they're there for good reason.
Yeah, and I would say I think they are flexible enough to, allow us to make good income for the participants, but also stringent enough that we're not taking unnecessary risks in the portfolio. I haven't in a long time had said, oh, I wish I could do X, Y, and Z. Maybe when rates were near zero, I wish I could have gone longer and some of the things, but it's lucky I didn't because the Fed raised interest rates so quickly that it was good that I.
But I guess my real question is, they are there, that you do bump into them occasionally, and they do work.
Yes, yeah. And of course, all of those limits are input almost exclusively by Tim and Dan Zarling into Bloomberg. So even if we missed it and tried to buy something, if it was going to trigger one of those, we can't push it through in the system. So,
how do you come up with those caps?
most of them are inside the investment policies statement for STIP. Which was approved by the board, and occasionally we will rework that and bring it to the board for if we want to change something. But
Way back when, we had some problems there, and we spent a couple board meetings extensively discussing those. And
Do you ever compare them to other states and things like that? How they deal with it?
We don't
we sort of look to RVK to give us best practices. We'll come up with, is this insane? Does this work? And then we get their feedback of that's within the norm. What if you tried this? What if you tried that?
I would say we see that, we see other money market funds and things out in the market as well, Porter, so there are comparisons. A lot of states don't have a STIP portfolio the way that we do. There are a few. so-
But there are other institutions
There are
that you
others.
can compare it to.
And so we do look, I mean, you see that. I wouldn't say we go out and check it and try to, you know, see where they're at versus us or something, but there's a gut check there, I guess, when you see those from other people, and I don't think we're outside the norm, broadly speaking, from what others would be doing.
All right, moving on to number 3, liquidity risk. As Kirsten mentioned earlier, one of the primary focuses of STIP is to meet client redemption needs. Super important that we have the cash available to meet those needs when our participants need them. To do so, fortunately, STIP inflows and outflows are pretty predictable, so that helps us there a little bit. There is some additional volatility with local government transactions, just because there's not as much transparency with those as there is with like the state agency transactions. But even in that case, the local governments are really good about letting us know when they have a big transaction coming up, and we can prepare for that. And then we also work closely with the other investment teams, the accounting team, and the Department of Administration to stay up to date on any cash flows. We take all that information from the various teams and from local governments, and we put it on a calendar that we manage every day, and this calendar is just a nice visual representation of all the inflows and outflows we have. So it'll show all the maturities we have for that day and all the payroll or whatever we have going out, and just making sure that we have enough inflows to meet the outflows.
What does the increased local government participation, what does that mean?
So the volatility there, is that what you're talking about? So the local governments, those, how do I answer this? Operate a little bit differently. So their transactions actually move cash out in and out of STIP, whereas the state agencies, it all stays inside.
Yeah.
I didn't realize that you had state or local government money in that fund as well as.
Right, so some
That's what I
states
was
have a
missing.
state STIP, some states have a local government STIP. In Ohio, they actually fight with one another and if the local government has a good asset-backed security, they don't want anyone to tell the state STIP that they've got it, because they want to beat them on performance. But, and that's why, part of why our costs are so low.
But isn't it also, the state has a cash account, whereas local governments are gonna move money in and out of their cash and STIP accounts. But the state has a separate cash account.
And I would say the local governments, their participation isn't mandatory like the state agencies. They can elect to be in STIP, but they don't have to invest in STIP. And that is why if say STIP was 100% local governments, they might say, well, this bank's got a great CD rate, I'm pulling all of my money out and going there instead. And that's why it can increase the volatility. You know, the local governments have other options.
Our approach to that has been, if you can get a better rate for your taxpayers, go. We will make it work. It's just easier to give them flexibility. And we see them pull in and out, before a bond levy election, you'll see the school district all of a sudden go down and put a couple million with the local bank, or you'll see one of the local banks go say, hey, we've got a lot of employees here, you should put some money with us. We hear about them, but we just don't engage.
Well, there's also a similar natural volatility, same as there is kind of with the state, I guess, but the tax seasons, as you're getting taxes rolling in or things getting paid back out, you see that kind of on an annual basis as well, to a degree.
All right, so most of the flows that I've talked about so far are known flows. So the most risk is with those unknowns, and to mitigate that is we do have a minimum liquidity requirement. That's a percent of STIP. And that just means we're required to hold a certain amount of liquid assets in the portfolio, whether that's money markets, treasury bills, cash, and whatnot. So that helps meet those if we were ever in a bind. All right, number 4, our last one, interest rate risk. This is the risk that the value of the portfolio will change due to the movements in treasury rates. This risk has to do with the inverse relationship between interest rates and bond prices. So say, for example, if interest rates are rising and the weighted average maturity of the portfolio is longer, STIP is short, so long is relative, but we could miss out on additional yield as we're stuck at that lower level for longer. Whereas vice versa, if interest rates are declining and we have a shorter portfolio, we are forced to reinvest at lower levels than if we were slightly longer. That said, and as I mentioned before, because STIP is so short, this risk is pretty minimal. Any other questions with that? All right, I'll go ahead and hand it back to Kirsten.
Moving the camera. All right, I am on slide 8 here. Going to talk about STIP performance. The chart here shows that the main factor in performance for STIP is the yield. You can see the performance follows that where the yield is very, very well. And if you look at the very right side of this, you can see that high yield that we're getting currently, it's higher than it's been in the last 15 years. And you know, why is that important? Well, our participants get to keep their income and use it on various operations, expenses. We always talk about how many snow plows we're putting on the road, you know, which is great. So I'd like to point out the last calendar year, 2023, STIP distributions were over 413 million. So that's a big number. You were wondering, probably the biggest calendar year we've had. So very cool. That's where you're all supposed to go, wow, so much money. Wow, right? Okay.
We are, so just tracking general fund revenue. Over the last several years, it's always been income tax first, property tax second, and then others bounce in and out of third, and it's usually a pretty distant third. Third highest revenue stream for the state of Montana last fiscal year was investment income, just off of STIP yield.
That's pretty good.
Yeah, that's impressive.
It's around 5 1/4 right now. Is that where you're at?
It's about 5.35 or so.
5.35.
Yeah, so in conclusion, we have a competent team of professionals managing the risks associated with STIP, who then try to maximize the income for the participants. This is where I would hand it over to Willie to do a Bloomberg presentation, but I'll just ask Sam to pull up some pages and I'll keep going.
Go ahead and throw them under the bus.
Oh, yeah, right. See, I don't know why you wanted to show that slide. Yeah, and as most of you already know, Bloomberg is our main resource for managing STIP. It's our order management system, and we keep track of everything on our investment side through Bloomberg. This first page here, would you extend that out a little to the 5? Yeah. So here is the effective Fed funds rate. Looks a lot like that chart I just showed you with the yield and STIP following very much what the Federal Reserve is doing. The last time we did a STIP deep dive, if you look down in February of 2022, the effective Fed funds rate was 8 basis points. Now it's at the 5.33. So very different market environment than last time I was in front of all of you. which makes it fun. And, you know, Sam had talked about interest rate risk. You know, the market kind of changes every day, and with a lot of uncertainty about when and how much the Fed will cut, that makes it interesting in managing STIP. We'll move to the FOMC dot plot tab next, and this is the market's expectation of where rates will be, as well as what the Fed's is saying where the rates will be going forward. As you can see at the end of this year, there is some discrepancy where the median is, where Sam is hovering over for the Fed saying the dot plot, the market, which is the white line and the purple line, is thinking it will be lower. So they are expecting more cuts more quickly than the Fed. I will say our team view is don't fight the Fed, which you know, we tend to agree the higher for longer, at least in the current environment.
So the markets are expecting the decrease, right?
Yep, until you get out to 2026 and it flip-flops, so yeah, kind of interesting. How sticky is inflation going to be?
Kirsten, maybe because you've got it up, maybe you could talk just a little bit about how much that has changed in the last couple of months.
Yeah,
Market
definitely.
expectations versus.
Yeah, would you change that meeting date, Sam, and we can actually go back? Will you do the 6/14 one? Yeah, so you can see here, I guess you can't exactly tell, but it's changed a lot in the last, what is that, 8 months? And I'd say we, again, don't fight the Fed, so we have been running a lot of stuff shorter than going long. A lot of our competitors have been buying, you know, 1-year agency discount notes that we have stayed out of, and the brokers try to argue with me, everyone else is buying it, why don't you?
Well, answer the question for us, and why are you staying so short?
Yeah, I wouldn't say so short, we're shorter than we normally are, and I would say that's because you're not getting paid to be.
To go out longer. I would agree with that.
Yeah. Oh, very cool. Next, we'll move on to the Bloomberg Treasury and Money Market screen. So if it's Willie or Sam or I, or even Ramasco on the rare occasion managing STIP, this is kind of a nice starting point to see what is going on each day in the market. The top left corner has that Fed funds rate. In the center on the top, you can see what bills are doing. On the right, kind of in the middle, you can see where the overnight SOFR rate is. And then if you scroll down to the bottom of the page, also all the economic releases that either came out today or are coming out are listed here. And so this kind of sets us up for the day. If something looks different than the day or the week before, we can click on any number of them and see why. So that's very helpful. Let's see.
So I know we pay a lot for Bloomberg,
Yes.
but you couldn't exist without it, right?
Not.
Well, I shouldn't say that in case you're negotiating. But
Yes. Yeah, I'd say not at this current time. We would not have a way to manage our internal fixed income without it.
Probably, I don't know of a company in this kind of business that is hated more than these guys, but provides a more essential tool.
Right.
Yeah.
I mean, you can't exist without these things.
And it's 26,000 a terminal per year.
Yeah.
And there's no negotiating.
Yeah.
Whether somebody's on it or not.
Yeah, I mean, if we have someone who has a terminal leave, we just leave it on so we don't have to pay the hookup fees and the initialization. So every once in a while, you'll walk into my room and I'll have a Bloomberg terminal for 3 months and then we'll hire someone and it's gone. But there's no negotiating, but there's also no doing the job without it.
Sam, would you pull up a boom screen?
Do they have a lot of other options you can get with them? Or- I
With
mean, why are they coming here if they're just gonna give you a number?
I mean, full transparency, we get a lunch out of them, so one. I think they are interested in customer service to some limited extent of, are there things we could do better? Some training that comes along with it.
They're trying to sell you the add-on product, okay?
Right.
There's lots of other things they can turn on and move for you that they have.
We don't buy the clear coat though.
So Becky, is what we're doing with Bloomberg and things, is that what you'd
Absolutely.
recommend or
Yeah,
whatever?
absolutely what we see across the board.
Great. So this is the Bloomberg order management system here. This is, or open order management. So you can see what is for sale. And Sam is sorted by our STIP approved list. And so you can sort this by days to maturity if you know you need money for tomorrow or you need it for the next pension payment, things like that. You can sort it by security as it is now, so you can see how much you're getting paid for that overnight versus going out. You could also sort it by the discount or the yield of the security, see what's looking good. The Barclays CCP is a floater, and that's why it looks weird up there, but the other ones are discounted ABCP mostly. We also have a government screening here, but yeah, are there any questions on this screen?
You're not gonna buy anything, are you?
No, unfortunately.
No,
we-
I think fortunately.
Yeah, I was gonna say, well, with the pension payments tomorrow, we don't have a ton of cash to spend other than that, so. Great. Next we'll go to the Bloomberg decision support. So this is showing what we currently own in the portfolio. I know that's kind of small for you to see, but it has all of our positions in here. This is part of our export to our calendar, so that you can see what days are missing maturities, things like that. Yeah, let's see. Trade blotter. This screen shows anything we buy in the day will show up here. Any maturities we have, coupon payments, journal entries. So this is showing, as of today, you could have a longer date if you needed to, but showing us what we have going on. We match this up with what State Street tells us for our forecasting as well. So we make sure they're not missing anything, have a double check on them. So that's great. You were asking about limits earlier, Porter. The next tab here is our compliance manager. I have opened it to our 3% max in any issuer name. In this case, it's parent issuer, because sometimes the banks will be out of the New York branch or things like that, so keeps them all together here. The yellow part means we are getting close to our 3% limit. You can see the 2 out column says how much room we have in the name. We try to always keep that, 5 million if we can. Of course, if you click into, say, the Swed Bank at the top, you can see where our maturities are there, so you'll know when you'll be back under that limit. Luckily, nothing's red today, so we look great. We're not out of compliance anywhere. Of course, that's a when purchasing limit, so as the balance and STIP changes, occasionally we will have something in red. So that's great. And then, yeah, I kind of already mentioned that Tim and the operations team have these added controls in here, so we can't, if I tried to go out right now and buy some Swedbank and I put in a trade for $10 million, it would not let me.
Because you'd be out of compliance.
Yes, and I would get a warning and it literally would not let me hit the button, so,
Well, could Sam do it?
no. Yeah, luckily it's firm-wide. So, yeah, that's great. Are there any other questions with Bloomberg or STIP in general?
So I have a question for you. You were talking about, right now you don't have a lot of cash because you got payments going out, right?
Yeah.
So the question is, within STIP, you have a cash balance, an actual cash balance?
I have maturities every day.
So you're counting on those maturity, you're managing the maturities to have the money that,
Yeah,
okay.
yes.
And anytime, I mean, just to kind of dive in a little bit there, like anytime, let's say I'm gonna sell some equities because I think equities are expensive and I want to raise my cash balance or something. So I'll send out the email to Jason, let's say, to sell some domestic equities, 50 million or something. And I send that to everybody, even though I'm sending it to Kirsten and the whole team as well. I'll probably walk down the hall and tell Kirsten, hey, 50 million, probably before I even send the email, 50 million's coming your way. Or particularly if I were to go the opposite direction and be pulling something out, I'm probably gonna walk down and talk to her first and say, okay, I wanna spend 50 million. Have you got it today? Is that gonna cause you any problems for anything? 99.9 times she's like, no, it's fine. Okay.
Yeah.
Got it. But, we're always having those conversations as anything happens that's, sort of a higher dollar amount, because it almost always impacts STIP.
Yeah, and we do have liquidity minimums. We have to have at least 10% of STIP in daily liquidity and 15% in weekly. We're currently over 20% daily liquidity, and again, that's more from a management perspective. You're not getting paid to go out, so.
But it's still invested, right?
Yeah.
So what time do you come to work usually?
Well, I start at home at 5:30. I drop my kids off at school and then I get into the office between 8:30 and 9.
And you have a self-driving car?
I wish.
And then the most important one is how much coffee do you have today?
A lot, yeah, a lot. I think I had 4 shots in my coffee this morning, so shots of coffee. To be clear. Great.
Okay, thank you.
Yeah, thank you. Sorry Willie didn't get to get up here and chat with you about that, but
Well,
next
it's
time.
just like a man, right?
Yeah, exactly, man.
My wife always says, now you show up.
Right, yeah. Perfect.
Oh, good.
And no one on the call had any questions, I didn't see.
You didn't see any?
Nope.
Okay,
Good. Well, thank you.
great, thank you.
So I think we can move along. And Becky, I think it's all up to you now.
Okay. Would you like me at the podium or should I stay around the table?
Whatever is most comfortable for you.
I'll stay. That's all right.
Dan does have a red light up there.
I know, I just didn't want to see it in the countdown when it went to yellow, or actually green, yellow, red. Actually, I was at a presentation last week that actually had that.
You wouldn't,
CalPERS
you
used
would not dare.
Well, we'll start off with, this is behind tab 6 with section 1, which has some written commentary. There's a couple of interesting charts I just wanted to call your attention to. If you look at the section 1, page 4, at the bottom of the page, just looking at that particular chart. Figure 1, this actually tells you a lot about what happened at the end of the year in the fourth quarter. A lot of the return for 2023 in many markets was what happened at the end of the year. If you look at the green bars compared to the blue, the green is the quarter and the blue is the year. And when you look in some asset classes, like the aggregate fixed income index is just to the right of center, you can see the entire year's return was the fourth quarter. So we saw a big backup in rates, rates actually went down, prices went up, and all of a sudden we had a good fixed income year. And in the equity markets here in the US, there was a lot of euphoria about what the Fed would do this year, and that they would start cutting interest rates. And there was even speculation in December that the Fed would cut interest rates 6 times in 2024, and may even start in the first quarter. Well, that's been backed up somewhat and more moderated as we've looked at more recent economic data. And the Fed has messaged, we're not ready yet. So now there's articles about, well, what if the Fed doesn't do anything this year and stands pat if inflation kind of remains a significant issue? In fact, in looking at kind of the break-even inflation rate that would keep unemployment around 3.5%, it isn't the 2% target that the Fed's been working with, it's actually a little above that, something more like 2.5%. So again, Fed's really driven by data. You probably saw that GDP for the end of the year was actually moderated down to 1/10 of a basis point, less growth than what was originally estimated for the way we ended the year. So there's a lot of conflicting signals, and as you probably also know, the Fed looks at the personal consumption expenditures number. That's actually coming out on Thursday, so we'll see what trends are there. But if we look at where we were at the end of yesterday, that number, an annual year-over-year change for those kinds of expenditures was about 2.9. So again, we're continuing to watch the data to see if inflation really is becoming close to under control or normal levels. But the impact on the capital markets of that euphoria was pretty strong for last year. You could see when you look at the one-year numbers for 2023, it's obvious the US large cap equity market by far had the best performance of all these investment tools, these asset classes that you see on this page. But a lot of other asset classes had good results as well. If you look at figure 2, which is on the next page, this is looking at the federal funds rate going from the beginning of this year to the end of this year. And Kirsten already went through some views of the dot plot and where rates actually may be. But again, I don't think anyone would be very surprised if we saw that the federal funds rate at the end of the year is lower than where we are today. So I thought that was kind of an interesting chart. If you move to page 6, we just have a high-level view of performance. This is looking at our total fund composite relative to the public employees benchmark. And for the quarter, we had a return of 6.3%, which is an amazing quarter if you look at what our assumed rates of return are for the pension plans. That was a lot of growth in a quarter. For the fiscal year to date, that's 6 months. This also shows you, if you include that 6.3% rate of return plus what happened in September, our first fiscal quarter was negative. And that, again, wasn't a big surprise relative to the market environment at that point, but the euphoria lifted up. So our fiscal year to date return was 4.3. Again, a great 6-month growth rate. When you look at longer periods, that's to the right-hand side, 11.5% for 2023. And our 3, 5, 7, and 10-year numbers follow. Those longer term numbers are running between around 8% and 9.4%, with a lower number for 3 years because of the 2022 sell-offs we saw in fixed income and equity simultaneously. So versus our custom benchmark, as sometimes happens, our private investments at this point are not following the return trends of the equity market. They tend to lag somewhat in their mark by a quarter, and this report is a quarter. So we do have, as you look at this return pattern, we're beating our index, our benchmark for every period here for 3, 5, 7, and 10 years, but we're lagging it in the near term, and it's primarily those private assets, although there's some other details we'll talk about in just a moment. Versus peers, we have a little bit more in private equity than some other peers. Some others have more in public equity, which had the big rally last year. And so when we look at our relative rank, we do rank a little bit lower than some of our peers in the nearer term. In the longer term, excellent ranks, above median for 1 year in the 38th percentile and the 24th for 3 years. in the 18th percentile for 5 years, same for 7, and in the 6th percentile for 10 years. This is a long game. That near-term underperformance in rank versus our peers is not of a concern to us at all. If you move to page 11 now, actually like this, it's kind of a concentrated view of the capital markets, but it has a couple of pictures that I thought were important to convey. One is what has happened to interest rates on the bottom right-hand corner. Actually, finally, we have a period where the most current quarter isn't the top line with the higher interest rates. Actually, you can see the green line is actually the second one as you work your way from the top to the bottom. And the blue line was the yield curve as of September. So interest rates did go down across all maturities as we look towards the end of the year. Again, on a lot of euphoria about the Federal Reserve and its future potential cutting action. So that did drive the returns of the bond market. You can see on the left-hand side, just immediately to the left of it, market performance on a quarter and calendar year-to-date basis. We'll go into the details of your performance here. This is how some of the benchmarks return. What jumps off the page? Red print, that's in real estate. We have seen this period for the quarter and the calendar year where we have seen real estate prices go down. They're still producing income, but the valuation for the properties has fallen. Now, keep in mind, when we were sitting here exactly a year ago, we were talking about real estate being one of the best performing asset classes, and actually is an asset class that does very well in inflationary periods. Well, with the rise in interest rates, impacts on valuations actually have been negative for a lot of real estate properties. Plus, you know, a lot of the more episodic details about what's happening in such spaces such as commercial office spaces in large cities. We still haven't seen that complete return to work paradigm. There's still a lot of empty office spaces out there. So again, this is a mark-to-market environment that we're seeing in real estate. It's not a real estate crisis, but a negative period as we see here for the immediate period. The only other asset classes that we saw a negative return for last year and the quarter was in commodities. The opposite was true in 2022. That actually was a very strong period for commodities. So interesting kind of reversal there. If you look at some of the economic data that's just above the index data as of the end of September, you do see that federal funds rate that you saw from Kirsten at 5.3% currently. Looking at inflation trends, break-even inflation levels are showing 2.2% over 10 years. We just finished our capital market assumptions trying to look forward and still believe that long-term inflation rate's going to be a little above where the Fed is targeting, something more like 2.5. It's just kind of persistently between 2.25 and 2.5, not the 9% that we saw 18 months ago, which was a big shock to the markets and to investors. Another couple things I want to note in that same section is the CPI, that's inflation, the headline number as of the end of the year was 3.4. We continue to update that, and looking more recently, it's about 3.0% right now, but that core inflation is still elevated. It's almost 4% still. So excluding food and energy, inflation is still a little higher than in that headline number that you see. Unemployment, 3.7, this crept up a little bit as we looked at the end of last year, still well below where that Fed trigger point is for being concerned about unemployment. So again, if you look at a long-term goal of something like 3.5% for unemployment, we're not far off that mark at all. And one particular boost to international equity returns as we look at the last quarter of the year is that the US dollar weakened somewhat towards the end of the year. And you can see a basket was 118.8, it was 123 almost in September. When the dollar is weak, we actually get better returns for international investments when we translate them back to the US. So that was something that was interesting to note. Finally, and then I'll move along a little bit more quickly, upper right-hand section of this page, You can get a historical perspective on unemployment. Look how low that blue diamond is relative to the history of the data going back to 1948. We definitely are at those levels considered nearly full employment. Inflation, you can see that it's a little above median compared to history. If you look at the middle section there where you see the top two shaded bars meet the bottom two shaded bars. US government debt as a percentage of GDP, look where that blue diamond is. It certainly is a lot more expensive to hold the level of debt that we have right now especially for new issues. So that is something that will be an issue for our economy. And volatility is looking at the equity markets and related volatility. That's not a significant issue right now. It has spiked up during past periods of market stress and concern. And consumer confidence is nearly top quartile. So it's an interesting picture when you take all of these elements into consideration. And now page 12, this is great cocktail conversation. First of all, people probably don't talk about interest rates that much at cocktail conversations unless it's your fixed income
I'm not
team.
sure what parties you go to.
A bunch of investing nerds, right? But just look at the top chart. This is the path of treasury yields last year. We started the year at 3.79. We ended the year at 3.88. Wow. There was a lot of movement in between. And at the end of the year, it changed dramatically with those rates really going down. Again, a boost to fixed income returns. We actually got to a low of 3.3 at one point. So quite a ride and a lot of noise for when you look at the endpoints. If you were to take a ruler, you would have missed this entire trend. The other bottom part of the page you probably would have talked about in a cocktail conversation. If you look at in green, this is the Magnificent Seven returns last year, which you have full allocations to in your indexes, so you're not missing out here. But if you would have had $1, you would have had $1.85 after investing in those stocks for the year. So that's an 85% rate of return. If you just held the S&P, a 26% rate of return. So if you do the math, that means 493 remaining stocks had a fairly good return, but not as exciting as an 80% plus return, a return of 10.9. An interesting statistic I saw in the news this morning was that if you take the US stock market, it makes you worry about the concentration of the Magnificent Seven in our stock market. And there's been a lot of articles written about the fact that if you hold the S&P, you hold a growth index now, because you have a lot of technology allocations there with the Magnificent Seven. But if you take the Magnificent Seven, you know, in the top three in order are Microsoft, Apple, and NVIDIA, and then you add the rest of the Magnificent Seven and three other stocks, which is Eli Lilly, Berkshire Hathaway, and Broadcom, we are still a diversified stock market in construction. In fact, if you take the 10 largest stock markets around the developed world, we're the second least concentrated. So even with this and our large market, we do have a big concentration in these growth names, but not as much as other markets that I would warrant are actually a little thinner than ours and smaller than ours. So it is an interesting question to think about. Page 13, I will move through quickly. I just wanted you to note two things on this chart. Bottom left-hand section, US stocks are expensive again. If you look where the blue diamonds are relative to history, large cap equity relative to 1900 is near the top valuations. Large cap equity going back to 95 is in the top quartile, as is growth. Value investing, not quite so expensive, and small cap, not so expensive. But again, due to the Magnificent Seven and other stocks that have just really grown in price, that has been causing stocks overall generally to be considered expensive again. And if you look on the right-hand side, this shows you by sector. In light blue, the returns for the year, and in dark blue, the returns for the last quarter. And yes, the returns for information technology with a return of almost 58% is not a typo. That's the entire sector. Consumer services were up 56%, and consumer discretionary 42%. And you look at a few less exciting sectors last year, like energy, actually negative returns for the quarter and the year, because energy prices basically went down last year. So very interesting environment. The next page, if you compare now on the bottom left-hand section for international investments, the blue diamonds, and with the exception of growth, international equity, which is the second set of columns in that bottom left-hand corner, the second set from the right, you can see that a lot of those diamonds for international equity, and this is for the ACWI, the developed world, and then value strategies, are all quite cheap by comparison when you look at their price to earnings, and a few others that aren't necessarily as emerging markets and developed growth equity. So very different environment for international, but still some very heady returns when you look in the bottom right-hand corner. Japanese stocks were up 20% last year. So very productive returns there. In Europe, without the UK, was up about 22%. Looking at fixed income on page 15, you can see some of the spreads, that is spreads relative to various measures, including treasuries. Spreads are not high right now. There's not a lot of fear right now in the marketplace. That's being reflected in yields. And there were some very good productive returns for most fixed income strategies, as you can see in the bars on the right, whether you're looking at the dark or the lighter blue, very good returns overall. I'll have you turn to page 17, the last section of this page, and I promise we'll go faster through the rest of the review. But if you look at this quilt chart and just think about trying to pick the best performing asset class, you have to do it in advance, of course. It's really fascinating just to let your eye go across the top row for every single one of these years and look that even as well as the S&P 500 has done for so long, it isn't the best performing asset class for a majority of these periods that you see right here. Actually, that dark olive green is the S&P, and it's shown up twice as being the best performing asset class. So it is very difficult to find patterns here. If you look at 2022, the top performing asset classes in purple, those were commodities. And look where they are this year, next to the worst. So, in general, equities generally did extremely well. Fixed income actually did well, as I mentioned. And when you look at some of the other strategies here, the worst performing in this case in this period for the calendar year to date, which is 2023, is real estate. So any questions about the market environment before we go to section 2?
You had mentioned you're working on your capital market assumptions. Is there anything that you're ready to share with us?
The changes were pretty minimal, actually. The general tone is that fixed income is the asset class that people are excited about again because yields are higher. So we'll see how long yields remain higher. There wasn't a lot of change in most categories there. Equity still remained attractive. US equity, we cut a little bit from the expected return because it's more expensive today. Left inflation alone, so not a lot of changes. If you think about the capital market line extending in volatility and expected returns of volatility horizontally and expected return vertically, if it's a line from cash in the bottom left-hand corner all the way out to emerging markets and private equity, that line just shifted, and you could plot all the asset class assumptions along them, just shifted down a little bit. So volatility up a little bit, expected return down a little bit for some of those asset classes, but it's so marginal. We're talking 25 basis points in some cases for changes. So a lot of effort for not a lot of change, but that's what we do every year.
They just put out their kind of your summary document. I saw it a couple of days ago. I can send that around to the board if you care.
Yeah.
It's fairly short. It's, I don't know.
Yeah,
It's
I'd like to
it's
see
8
that.
pages of the summary of what that was.
Yep, the process and the results. All right, so let's move to page 4 of section 2. And this is just giving you an update on the total of the retirement plans on page 4. And that is showing you a 14.6 And for the period ending December, 14.6 billion. And you can see the PERS and TERS plans at 7.1 and 5 billion respectively in the upper right-hand corner. On page 6 is the returns. We've already gotten a sneak peek of this. One of the things that we noted, of course, is not being as concerned with just a miss on our benchmark for the quarter to date, fiscal year to date, and calendar year to date. Again, it's the private investments that are really driving this, but long-term has been additive if we look at our returns versus our benchmark and our returns versus our peers. But here you get to see both PERS and TRS here, very similar returns as you look at 4.3 versus 4.29 versus 4.28 net of fees for PERS and TRS respectively. But the thing this page shows that the prior schedule in section 1 doesn't show is the year by year, going back to just a few years. So we've got just past the 20-year column, you can see 2022 and that painful calendar year when equity and fixed income were highly correlated, unfortunately, in that year, and both lost returns. And in fact, it was the worst bond market that was in the history of the index in 2022. So nice to have a productive 2023 of a return of 11.5%, as you can see on this page.
Well, I always hear how bad 2018 was, but is this actually telling us 2022 was worse?
So much worse, yes, absolutely. Let's go ahead and move to page 9, and we'll show you what your asset allocation structure is versus your public plan peers that are greater than 5 billion. And the bottom section of this page shows that you are the green diamonds. You are right at median in terms of how much U.S. equity you have. You have a little bit lower non-U.S. equity relative to peers, just slightly. Your fixed income is right in line with your peers. In fact, you have just slightly more compared to a combination of your peers' allocation to U.S. fixed and global ex-U.S. fixed. That's a fancy name for saying international fixed. Alternatives, you're right at median, but I would say your mix is different because you don't have hedge funds. And when we look at your long-term results for your private portfolio and your alternatives generally, your returns are going to stack up very well to peers because it's more dominated by private equity returns, which have been very good. In fact, a consistent message to this board in the past is how much value added they have in your returns in your history and currently. So this year, again, a little bit of a headwind there. Real estate is really the only category where you have a higher allocation overall. But again, that has been additive to your program. This particular year was stressed in terms of prices being written down. But again, this is a long-term investment that we think real estate remains an important part of your structure. So if you'll move to page 11, this is looking at risk and return. And some very good news here. On the upper left-hand section of this page, we have a 5-year analysis of risk and return. Green diamond is the PERS retirement results, and the circle is the related benchmark. The squares are various peers. And what this is telling you is you had more return than your peers with less volatility, and you've had more return with a lot less volatility than your benchmark. And that's just due to some of our private investments don't have a good benchmark, and we compare them to the public markets equivalents as close as we can. So that's one of the reasons for the differences there. But you are in the right quadrant of that risk return schedule on the left-hand side. And if you look at the following page, which is for 10 years, the same news here, same conclusions. The other thing that we like that we typically don't talk about as much is when we look at your total plan on the bottom left-hand side, standard deviation, how much your returns move around period to period relative to peers, you have lower risk than other peers when we use that measure. That's pulling out of that risk return chart, just the risk in isolation. And relative to other peers, you can see that you rank in the 63rd percentile. In this case, you want to rank closer to 100 than 1. You want to have less volatility than your peers, and you absolutely do. The same is true for a measure called downside risk, which is the second column from the right. This shows you that when the markets are down, this is defined by your benchmark having negative returns. You tend to do much better in those periods. In fact, you have much less downside risk than your peers and than the benchmark itself. I was going to quickly go to page 13 and just point out, we've already reviewed the size of the retirement plans. Here we've got CAP and the STIP as well as the trust funds pool in the upper right-hand section. Together, that's almost $26 billion, as you can see in the upper left. On page 14, looking at the trust funds pool, and again, it's dominated by fixed income, but it also has some diversification as well in real estate and some non-core fixed income. Here, you can see the return was 2.6% for the year, 2% for the fiscal year to date, and 4.8% for the quarter. Again, heavily influenced by a large fixed income allocation there. But in this particular period, the real estate component wasn't as helpful as it's been in past years. But no concerns. And wow, I keep looking at the STIP number for return for 1 year of 5.1%. Remember all the years, and you can see it to the right when you blend into a 5-year number, that return was under 2%. So nice to see a higher yield return for that reason. The structure of CAP is on page 15 in terms of asset allocation. No significant changes here, but just to show you what the structure is among the various asset classes. The small list here, of course, are cash held in CAP and real assets, which is just under $1 billion. And the largest component, of course, is domestic equity. If you move to page 16, this is really, to me, an investment nerd here, on page 16, I always think about your asset classes as tools that we use to build a portfolio to meet the needs of the beneficiaries of all of the pools that you're responsible for. And when we look at this particular calendar year, you'll not be surprised given the capital market update that domestic equity was the star of the show last year. When you look at the third column, start from the top, domestic equity, your domestic equity returned almost 26% as indexed. International equity is both indexed and active. It had a return of almost 15%. And these are net of fees here in these results. We have seen a little underperformance in some of the active managers in international equity, both some of the growth-oriented managers and value a little bit in emerging markets, small cap, international small cap. Nothing that's been long-term and persistent in terms of the types of international equity that you hold, but just for this particular period, into 3 years, we have seen a little bit of that. Again, no significant concerns there, but for the year in absolute returns terms, 15% rate of return is a good result and helpful for the total fund. Your core fixed income, 5.4%, non-core, almost 11.1%. Underperformance here, a lot of your high yield managers really struggled, and yet compared to their peers, they didn't struggle except for one manager. Most of them actually had above median results but couldn't beat their benchmark because they weren't in the lower quality securities. So that's been something that has been intentional in terms of creating the agreements with these managers, but it's also one of the reasons why I went through the fee negotiations with them, is just realizing that relative to the chance of beating the benchmark, they had a difficult time, and all higher quality, high yield managers we follow have had this problem. And as we look at last year, that was a significant issue. When we look at the actual return they generated, 11.1, that was a very good return. Real assets, an 8.5% rate of return for the calendar year, a good contribution towards the fiscal year as well. Real estate, this is where we see that red ink. And for the fiscal year to date, that's a loss of 1.6%. For calendar year to date, about 5.8. So again, nothing out of line. In fact, compared to other real estate portfolios that we track through peers, this is not a bad result. In fact, it's been above median, and you have a bespoke structure between your core funds and your non-core funds that has worked well. Then your cash and then private investments, you can see at the bottom, when the stock market is up so strongly in the quarter and in the calendar year to date and fiscal year to date, our private investments are just not going to follow those patterns as quickly, and actually are a combination of both private credit, private equity, a variety of strategies. They've been additive in the long term, but when the stock market is surging, at least in the near term, we see more modest returns. A lot of plans that we work with that just strip out private equity by itself had losses for the final quarter of the year. So those are the bigger picture observations that I had on performance. I just thought page 18 would be a good page
Vicki,
to
before
look at.
you do that,
Yeah.
packet 17,
Yes.
comparing peers on international equity. You don't think that's worrisome? I know we've changed our portfolio and there's some reasons for that, but that's not a concern.
It's been a longer term trend. It's had to do primarily with plans that have less in emerging markets, and they're more of an EFA type of exposure as opposed to an ACWI that's really, putting your arms around the entire non-US markets. That's certainly, the emerging market component has been a drag in a lot of portfolios, but that's been one of the sources that we've seen there. Now, you underperform the index a bit too there, but a lot of active managers struggled in this period too. So not a concern, Jack. It's just been a long-term issue of peers combining a primarily developed world versus an ACWI, including emerging markets. It's been the longer-term driver. I don't know if you have any more observations than that, John.
No, I think that kind of sums it up. It's a very, you would know better than me, but I guess when we've looked at it, it's a very limited universe out there. When you go look for other managers that you might move to or shift to, we find a lot of things that we wouldn't invest in, maybe because they're too small, they couldn't handle our size or things like that. And so structurally, I think there's a lot of noise, I guess, is what I'm ultimately trying to say in the number here. And I guess I take that peer ranking somewhat with a grain of salt, but I completely agree with what Becky said about kind of emerging, whether or not you've got an allocation to emerging or not.
Any more questions on the material we've gone through so far? I was going to end unless there's anything you want to dive into in more detail on page 18. This is something we do keep an eye on, which is what is our sensitivity here relative to what happens with the stock market, especially when we get a big positive impact like the end of last year. And then when we get a negative impact like 2022, what is our equity beta sensitivity as a total plan? And when you look at this particular chart, it may not be all that interesting in trend, but there is a trend I wanted to show in here. One of the things you can look at is the dotted green line is our retirement plan's total fund composite. If you were to plot a number of your peers on this page, one of the things that we've seen them do is they've become so dependent on the US equity market for a larger and larger portion of their portfolio because they wanted to look like 60-40 or 70-30. Perhaps they were tempted to not diversify as much. And so their equity betas have not been as steady as yours have been. They've actually gone up a little bit. In your case, you've actually come down ever so slightly in your equity beta. You aren't tempted by just allocating more of your assets to one market, which is the US equity market. So you participate when you have years like 2023 and a very strong return from the S&P, but you're more broadly diversified than that with the other asset classes. And you can see there's a number here that have very low relationship to what happens in the equity market that are along the bottom. Those have actually been very helpful over time in diversifying your portfolio. So I just wanted to point this out, that not only do you have an appropriate level of equity beta relative to your goals, but you haven't been tempted to just pile on to the best performing asset class and have even more with the hopes that it would continue to perform like it has for the last many years. You've actually built in a lot more diversification into your program. So that's important to realize from an overall portfolio construction.
There's a lot of pages here on our different managers. Is there anything that jumps out that's of concern?
One of the things I thought, if we wanted to dig a little deeper into fixed income, for example, we could look at page 39. I mentioned that a lot of your high yield managers struggle. This is just the structure of your non-core fixed income. And keep in mind that when you look at peers and how they construct fixed income is even less homogeneous than international equity. When you think about John's comments, a lot of plans actually combine core and non-core together. And so when you look at high yield managers not keeping up with their benchmark, that may be blended into what we call a core plus style. So there's less visibility about what of those additional tools like high yield or emerging market debt are working or aren't working. Here, we've got your core portfolio being managed in-house with very good competitive long-term returns at very low fees, to your point, Dan, thinking about the fee load. So you are paying those external managers for exposure to the plus sectors, and that's what the non-core fixed income is. So a reminder that you see on page 39 is the managers in that portfolio. You've got 3 high yield managers in Oaktree, Schenkman, and Neuberger Berman. You've got an emerging market debt manager in Payden and Regal that's newer, a preferred security manager, and the newest manager on this list is a convertible manager. These are all different tools that will, again, be helpful in return generation and diversification in your broad fixed income portfolio. So if you look at the next page, this is the manager detail, Jack, that you were mentioning. We could go into page 40. This is just showing you the high yield managers on this page. You know, first of all, having a high yield manager last year was terrific, and that you got a return that was about double what the investment grade fixed income market return. But if you had a higher quality portfolio, and if you look at some of the detailed manager pages in the back, you'll see that they just have a slightly higher quality allocation overall in their characteristics relative to the benchmark. But if you look at their ability to beat the benchmark net of fees, it's been negative for all 3 of them for the nearer term. Neuberger's had the hardest time relative to the longer history. Oaktree, it's just been in the nearer period of 1 year or less. 3 and 5 is above the benchmark, and Schenkman has been primarily in that 1 year and shorter period. For longer periods, 5 years, they were just slightly under. If you look at the relative ranks, again, Neuberger has been the one that's struggled the most. If you look at these annualized periods relative to peers, Oaktree has been, you know, almost top quartile recently, and at median for 3 years, top quartile for 5 years. Schenkman has been above median except for the near term periods. So, you know, it's an area where a lot of active managers really do struggle, and yet we prefer active management in this space than just hiring an index. You hire the index, you tend to get the very lower quality securities where there's a lot more risk involved. So this would be probably the area I would highlight as managers, just noting a consistent trend recently struggling to beat the benchmark. Do you have anything to add, John?
No, I guess I'd just say, we talked about it in the past, you can't really invest passively here. There are ETFs and things like that, but when you look at those types of things, the fees are actually as high, maybe higher in some instances, and they tend to dramatically underperform the active management, partly because the active managers are able to play against the ETFs in a lot of instances, because they're sort of locked into the very large issues and things in order to have liquidity. So there's a lot of structural issues there where you pretty much want active management, but at the end of the day, you're unlikely to beat the index.
Yeah,
That's just the reality. And Jason's talked about it many times. You know, we have taken a particular bias that we're going to be in the more conservative managers, with the full knowledge that, you know, those times when triple C's run, we're going to underperform, and that has been the case for a long time. We're okay with that. You know, at the end of the day, when the market does hit that wall at some point or another, the credit event happens that really brings down a lot of people. You know, our managers will shine. We saw that briefly during kind of the
Yes.
COVID pandemic.
Yeah.
It didn't last very long
No.
because the Fed quickly stepped in. But, you know, that's the dynamic that we've signed up for. They're doing what we would expect, and, you know, no concerns.
Okay. Other questions? You must have covered it all.
Okay,
Well, thank
thank
you.
you.
Just so I can stay awake, let's take about a 10-minute break is all. Okay. Just to get up and move around, and then we'll start again. So, all right. Okay, well, welcome back, everybody. Appreciate you sticking with us all. John, I get to turn it over to you, and you can complete our agenda today, investment update.
Mr. Chairman, members of the board, I'm on tab 7, investment update. Starting on slide 4, the economic environment. Becky covered it well, but you know, still, as she said, mixed economic data out there, but I think it is looking increasingly likely that the Fed's been able to reduce inflation without triggering a recession, at least not a major recession. And that is a pretty significant feat. I have to say I was probably a skeptic, but it's getting harder and harder to deny a lot of the good news that has generally been out there. In the economic index, the GDP Now forecast is projecting strong first quarter growth at this point. I have to look before I came in here, but it was, you know, 2.7, 2.8%, I think, the other day when I looked. You know, job growth has been pretty strong. You know, there's some skeptics out there. There's a lot of seasonal adjustments in the number that maybe it'll get revised down a little bit from some of the strong numbers we saw the last couple of months, but nonetheless, it seems to be pretty solid. And like Becky said, at the, you know, we're at 3.7, 3.8%, you know, unemployment rate. I mean, I certainly remember the days when the common knowledge was that, well, 4% was full employment, according to the Fed, and we virtually never got there. So pretty good. Retail sales been up and down a little bit. We had some weakness in January, but December was very strong. Inflation, as Becky talked about, you know, it popped up a little bit towards the end of the year, but kind of came back down with more recent numbers. Housing has been sort of a drag, I guess, if you will. Existing home sales hit a low in October, but even that has started to rebound a little bit and looking like we might see some stabilization there. It was up a little over 3% in January, which is generally a pretty weak month. ISM, you know, little weakness in the manufacturing number, but that's been trending the right way as well. And the services metric has been strong, 53.4 in January. And that, as you know, services is generally the biggest driver of the U.S. economy. So all in all, I think the U.S. economy is looking to be doing pretty well overall, and I would extend that to the broader global economy as well. So maybe if we turn to slide 5, you know, inflation, it's all about inflation right now. We've talked about it many times over the last few quarters, but Core PCE, that's kind of the purported Fed metric that they favor the most. It's actually, the core has actually kind of been at that 2% goal for the last couple of prints. CPI, which tends to be the headline number you see in the newspaper, has been higher, as well as kind of the non-core has been higher. The difference there is largely housing, shelter prices, which have not come down as much as you might think, I guess, indicating essentially that the housing shortage remains as it has for a long time. And we talked a little bit, or Becky did, and Kirsten did, I think the market got ahead of itself a little bit in terms of cutting rates. They were thinking we're cutting rates in March, a couple of months ago, and that it was gonna be, 6, 7 cuts over the course of the year. They backed way away from that, as the Fed has made it very clear that they are going to wait for more data before they are comfortable cutting rates, and that they're certain that inflation's under control.
Hey, John, just a question. Do you know of another time in history where inflation came down before growth really slowed? And I guess another time in history where the money supply has contracted without a recession? And I guess, do you have any theories as to why it's happening that way this time?
So, the short answer is no, not really. I think that's why everybody was, not everybody, but a lot of people were skeptical about the Fed being able to pull off the supposed soft landing, was that essentially they've never been able to raise rates, particularly that quickly, and pull this off. I don't, why have they been able to do that? I think there's probably a large mix of circumstances there, some of it having to do with the pandemic and supply chains. I think there was some validity to kind of the bottleneck in the supply chain there, and once that kind of loosened up, that helped things. I also think there's some demographic things going on in terms of the baby boomers retiring, and basically a shortage of labor is probably too strong a term, but less available labor out there than there probably has been during some time frames, which has resulted in that full employment. And at the end of the day, and I've got a slide here in a minute, I think the employment is kind of that key piece where if people have jobs and they're continuing to make money, that's going to grease the wheels and the economy is going to continue to turn. They've clearly been able to sort of turn the corner on at least that really high inflation. I think that's kind of the key thing everybody's looking at this point as well. Can we get that last mile and get back down to, even that 2.5? Becky noted, I think they'd be happy with that at this point. Can they do it? Now, it's getting a little less sure on that scale. So I'm not confident that rates necessarily will follow the path that we have currently. We're almost always wrong on where the path of rates is going. But what does seem more clear, I guess, at this point is that I would put a much smaller probability on the idea that we're going to have to continue to hike rates. And I think that's been an important psychological marker with the markets and with people in the investment industry, where at least if you can see a path that rates aren't going to go up further, you're starting to see more comfort level to invest and do M&A and do transactions in the real estate market or whatever it may be. So we're seeing that break loose, I think, a little bit. Does that answer your question?
Yes.
Hopefully.
Yeah, thanks.
So moving on, I think, to slide 6. Here's the employment one, I guess. I think the Fed has that luxury of kind of waiting to see whether or not they're going to cut rates because employment has been so strong. And I would put that somewhat on the dynamic that we have for demographics here. I'm showing you kind of the two main surveys that the market looks at when we talk about employment, sort of the establishment survey, which is what you would typically see in the headline number for unemployment, and the household survey, which tends to be a lot more variable. In the long term, they all kind of tend to sync up, and you can see, employment has come down, but from a level where we're essentially at close to full employment, if not full employment. So we don't need to create a ton of jobs. We just need to kind of run in place at this point, more or less. Maybe moving to slide 7, again, just kind of a different way to think about employment, that aggregate household paycheck. You know, it's come down overall, the growth, but still at pretty good levels, maybe slightly north of what we saw pre-pandemic. So normalized, I guess, if you will, to a certain degree. And again, I think if people have money, they'll spend it, and that's going to drive the broader economy. So from that standpoint, you know, it doesn't look like a ton of trouble on the horizon at the moment.
Is this paychecks or is this just income?
This is their paycheck, their aggregate paycheck, so how much are workers taking home? Like they're looking at, you know, total workers times hours times wages.
It's not adjusting for inflation.
The wages would adjust, I mean, the wages that they're making would be their current wages, so it would be adjusted for inflation from that standpoint.
Wouldn't it be just the wages they took home today? And if that's, you know, several percent higher than it was
Yes, to
10
your
years
point,
ago.
so to your point, yeah, so if their percentage change, there is an increase of 5% currently, let's say, then that, you know, if inflation's running at 3.5%, maybe they're, you know, 1.5% ahead in real terms.
Yeah, but if you look at it over that time period, they're quite a bit behind.
Yes.
Yeah, that's the point.
Other questions on the economic environment before I move on? All right, seeing and hearing none. Slide 8, assets under management by asset class. So as Becky noted, very strong performance in the fourth quarter. So 27.6 billion or so in total AUM at board. That's up from 25.8 as of September 30th. So an increase of 1.7 billion, primarily driven by that performance. Other than that, not much else to note here. Slide 9 by participant type. No real changes in terms of what you would be used to seeing in terms of the weights here of the various participants. Slide 10, again, no big change here in particular. CAP continues to grow modestly. Separately managed accounts, trust funds, relatively stable, and then STIP, as Kirsten talked about earlier, has been growing again, somewhat unexpectedly, I guess. Moving into pension specifically on slide 11, so well within all of our approved asset class ranges. Similar as we talked about the last couple of quarters, I think we're a little below the midpoint in public equities, both domestic and international, a little above in private investments, real estate, and the cash asset class. I would say that's been kind of both a function of market movements, but also using equities primarily to fund benefits and then pushing maybe a little bit more into the fixed income asset classes over time. Diversification for pension on slide 12, pretty similar to what you've seen in prior quarters, nothing really specific to call out there. Slide 13, pension net performance. So we continue to increase our assets over and above our benefit payments, most importantly over the 5-year and 10-year longer time frames. Pension performance on slide 14, you can see as Becky noted in the 1 year, really strong performance over that 1 year time frame. Fiscal year to date, 4%, looking pretty good. We've had a little bit further increase to this point in the first quarter here, so we're sitting at about 5.88% today. So continued modest increase in the first quarter here. You know, I do think the market has kind of turned the corner a little bit in terms of putting that rough patch, I guess, if you will, that we had in 23, 22, kind of in the rear view mirror, and feeling a little bit more confident in terms of stability, or at least the, you know, again, I guess rates not going up. I wouldn't put a 0% chance of bad outcomes, but probably, you know, a lower probability than the market was thinking about previously. And good long-term, you know, most importantly here, good long-term performance across really all time frames, but particularly the 10-year and since inception, well in excess of our actuarial hurdle. So questions about pension before I move on? All right, seeing none.
Question, John, can you put all that stuff on a straight line, please?
I'm gonna do it just
No,
for
he
you.
can't.
Carry on, carry on.
All right, slide 15.
His blood pressure just went up.
Assets under management ex cap, again, no real changes here in terms of the various weights with the different participants that we have here. Short-term pool on slide 16. I think I have much that I can add to what Kristen and team talked about earlier, but happy to address any questions that you might have in the realm of STIP if you have any. All right, moving forward to slide 18 with trust funds. Again, well within all of our approved asset class ranges here. Maybe the one call out with the real assets has moved up pretty significantly. We've got, I think we messaged it at the last meeting, that we had a capital call, pretty much all the complete capital call for ITE Rail, which was one of our rail car investments that I know we've talked about in the past, so they called down capital here. So that jumped up our allocation in real assets, and then we had a small allocation, or a small piece of the capital call for EQT Active Core, which was an investment that we brought to you at the last meeting as well. So they've started calling capital down. So moving a little more into real assets, which is nice to see here. Slide 19, trust funds performance. I would again point you to the bottom of that page where you look at the portion that says yield. And as we have discussed, if we look at the 1-year number, we're starting to see that yield move up a little bit as we're able to have bonds that are lower yielding. We have the low rate environment mature, and then we can invest them at higher rates currently, or for things like real assets or other things that are getting a higher yield than what we had. Some of those low yielding bonds during the bad old days of 0 interest rates. Questions on trust funds before I move on?
So can I go back to your comment on real assets? So you don't count it as an allocation until it's called?
Correct.
Okay.
Yep. None of these charts would show commitments, just what we actually have in ground. And that's true across the entire deck. State fund, moving to slide 20. Again, within all of our approved asset class ranges here, similar to trust fund, ITE Rail pulled down all of that capital commitment that we had with them. So you see the first number here for real assets showing up for the first time here. They also are invested in EQT Core, which pulled a little bit of money down in the first quarter, so that'll keep adding to that. And we continue to adjust the state fund portfolio, as we've talked about, within fixed income as well, extending the duration and adding to real assets. I mean, maybe to, recap very quickly, we have made a fair amount of changes within state funds over the last, call it 4 years or so, where we've added non-core, we added real assets, we changed the index and the allocation within the core fixed income portion of the portfolio here. So all of that's going well and continue to make progress there.
So John, I know you've had a meeting with State Fund. How's our relationship with them?
Well, I was not at the last state fund meeting, which was a week or 2 ago, I guess. John Ramasco went and Mr. Villa attended that meeting. So, yeah, you want to talk about that?
You didn't throw John under the bus?
He threw me in. No, I think we're in a generally good place. I think there's some, what I will describe as communication issues. And what I mean by that is the things we're looking at to determine performance are not the same things they're looking at to determine performance. So, for instance, very fixated on book yield. Well, from our perspective, that's not as informative as actual cash that can be used for benefit payments. So, you know, we will work through them, but I think generally, you know, we're breaking bread together. They're very comfortable calling, their team is very comfortable calling us. So it's just trying to narrow down sort of what the focus of the conversation should be on.
We continue to have good dialogue with them.
They're making money. They're still making lots of money. They made $60 million last year after they gave a $35 million dividend. That's pretty impressive.
Does that have anything to do with their new employees over there?
No.
It's you guys. It's this board.
Oh,
Are the targets or the ranges expected to continue to change, or is this where you expect these to be?
I think it's close to where we expect them to be. So, you know, we've talked to them, their insurance company. When we look at their peers, core fixed income is kind of the anchor, right? So I wouldn't expect, we kind of think in our heads like 75% core fixed income, the rest can sort of be in risk assets, right? And that looks to be an appropriate allocation relative to their peers, so I wouldn't see it changing significantly going forward.
And I think that'll be one of the topics of conversation with them of, you know, as we look at them, they're very interested in how other state funds are structured and what their asset allocation looks like versus the one we have currently set up for them. And I think the line in the Constitution of you are the allocators of assets and they are the payer of beneficiaries is a topic that we have to be more informative with them than we would with other clients, just based on how other state funds are structured, where the investment bucket is with the benefit paying bucket and they handle all of it. Whereas we have very clear delineated areas of expertise that we handle the investments and they handle the benefit payments.
And I think, you know, to go back, the changes that we've made over the last 4 years or so have been things that we have seen that made sense, somewhat relative to peers, but also in the broader diversification and asset allocation. And so we've made a lot of those changes that I think, you know, made sense. And I don't see a lot of other fruitful places to go at this point. All right, slide 21, looking at the state fund performance, pretty decent across all timeframes. Obviously, the 3-year number a little less there, but strong recovery here in the last year. As we talked about in the other portfolios, driven largely by their exposure in the equity markets and their non-core fixed income, and then to some degree being able to reinvest those maturing bonds into higher yielding, longer duration bonds has been certainly helpful to them. Other questions about state fund before I go on? All right, moving to 22, the CIO update. So already talked about most of this, but you know, Fed appears to be done hiking interest rates, knock on wood, say things like that, and then I'm usually wrong, so we'll see how it goes. But the market, certainly the base case is that we're going to get that soft landing. The market focus is solidly shifted to guessing when the Fed's going to next cut rates. Again, I think I'm far less concerned about that, and I think the market broadly has gotten to a place where at least they're getting comfortable that rates won't rise any further, and that is starting to break loose probably a little bit more activity. Bit of a cautious outlook here still. I mean, I think there's still some hiccups that could happen, but in addition, equity's a little expensive, certainly in the domestic markets. Becky covered it very well in terms of those different pockets, depends where you look in domestic equities as to whether things may or may not be expensive. But probably a little bias back towards fixed income here because ultimately, you know, core fixed income portfolio right now, yield to worst, a little north of 5%. That looks pretty decent, especially if you start to bake in a little bit of, if you really believe Fed's gonna start cutting rates a little bit and come back down. And you can pretty quickly get pretty close to the actuarial hurdle, so that's a lot of cushion, I guess, there, if you will. So looks attractive relative to maybe some other places that we might look to put money. We received the final report from Colmore, which we've talked about Colmore before, but they did not find any significant reporting discrepancies for our private asset managers. I think that was a good process, a good check on what we're doing, and I'm happy that was the result. That's what we would have expected. Good to confirm that. The executive director and director of operations and I went to the State Street Triennial meeting in Sacramento in January. The director of operations got horribly stuck in Salt Lake for several days. Got to live in a hotel for a while, which he probably wasn't that excited about. But other than that, relatively good conversation with State Street overall. You know, we continue to see the same types of issues, I guess, that we always see with them. We remain on top of it, trying to manage that process as best as we can. But all things considered, we're plugging along there, I guess. We've interviewed for investment and accounting interns for the summer. We are down to, got a couple for, I think, for the investment side and one for accounting. I've been in the process right now in Peggy Mac's capable hands to push those across the finish line here. But I think we'll probably get there in the next couple of weeks anyways, hopefully. And, looking forward to that. And we already talked about the desk manual that's sitting over on Director Villa's desk there. If you care to peruse all of that paper, you certainly can. And with that,
Send it to Maggie.
I will stop. I have to say, we did not, you know, this wasn't a policy document, so spelling and punctuation, that wasn't, you know, the paramount thing. So she may be disappointed with what she finds if she goes through that with a fine-tooth comb.
But did you find anything that, it was a good process, I'm sure, but anything that really needed attention, or is it just a?
I don't know if there was anything that really needed attention, but I think it definitely brought to light areas where we were like, oh, you know, nobody else knows how to do this, and we really need to get this on paper, or train, you know, do more cross-training here. So I think it brought those kinds of things to light. It wasn't that we discovered a bunch of issues or problems, but, you know, we probably just need to be better about disseminating that information and making sure we've got backups to the backups if we need it, particularly in some areas.
Good. Okay, so we're gonna call a quick audible and go to real estate next. Real estate, real assets, and then we'll pick up at macro attribution.
So the bloodbath begins.
So your human punching bag has arrived. All right, so if you all will join me on page 35. I will take you through real estate and real assets. So some familiar charts here, performance table, and then some comments. So look, there's no secret. Real estate's taking it on the chin right now. Higher interest rates, elevated cap rates continue to weigh on valuations. Transaction volumes are depressed. Credit conditions are tight. Fundamentals are mixed. In some cases, they're in the gutter. In other cases, they are reverting back to historical norms, and in other cases, they're doing just fine. So it's highly location and property type specific. But that said, I would say that things are starting to maybe look up a little bit. Maybe we're bouncing along the bottom. Transactions, we're seeing transactions both on the buy and sell side within our portfolio. Anecdotally, you're hearing more and more about that going on. So I'm hopeful that perhaps by the end of the year or early next year, things are really on a much more normalized path. I think it's highly dependent on what the Fed does, but that's kind of the state of affairs, and I'm happy to address any questions.
It's a discussion about, but interest rates. I mean, isn't it fair to say that interest rates are about where historical norms are? I mean, they're not elevated.
Depends on, I guess, what, I
Well,
mean, if you
they're
look
not
at very
they're not at the
long-term history, yeah.
3%, and that was low, right?
Yeah, we're probably arguably more at a normalized level, yes.
So how can they, are they gonna bring it down to normal, or what is it? Are you expecting rates to come down?
Me personally, no.
I didn't think so. I don't see it really coming down too much either.
But I think what you've seen is when you talk to some of the managers, they at least start to get that comfort level that, okay, it's not going up. They can work on their model, right?
Right.
They can put a number into the model and they can project that rates stay the same. And you can actually get to a level with the buyer and the seller that maybe makes sense. Whereas before, when rates are just doing a rocket ride up, it was like, well, where does it stop? Everybody, it's just kind of fear mode, right? Everybody pulls in their horns and that's that. So I think we're getting hopefully to a place where we see a few more transactions.
When you're talking about real estate, are you talking about commercial real estate or residential real estate?
Commercial real estate, although we do have a smattering of residential real estate in the portfolio that is owned by institutional managers.
But my sense of that market is that it's the oversupply that's the problem. It's not interest rates.
Well, I would respectfully disagree. It depends.
Yes,
So we have been
it's very
highly
location
oversupplied
specific, yes.
in the multifamily market. We're highly oversupplied right now in industrial, depending on if you're looking at multi-tenant light industrial versus big bomber boxes. So very much the case, but I would argue the preponderance of what has been going on has been driven by interest rates, and it's been much more of a capital markets driven correction than a supply demand issue. But you are absolutely right. Supply is off the charts right now at record highs in delivery for multifamily industrial for sure. And vacancy rates are manifesting that for sure right now. But more so back to, again, I would say back to normalized levels. Industry-wide, industrial still 95% occupied. Industry-wide, multifamily still 94% occupied versus 96% occupied versus in multifamily versus 98% occupied in industrial. So, big picture, you need to understand trends and for sure. A lot going on and a lot to think about.
Yeah, what I've been reading is it's the commercial market that's really got people concerned.
People are concerned.
And that's, in most major cities, that's a very big problem.
It's an issue, particularly with office.
Yeah, that's what
as these buildings go vacant and property taxes budgets shrink and services get clipped because there's not enough tax base. I mean, all these things are sort of rolling into one another. I don't know how acute it's truly gotten in places yet, but maybe it's on its way. We'll see.
And I think the important thing for us to keep in mind is we've had record years in this asset class the last several years. So yes, we're down, but we're not at this point below where we started. We had a 22% year 2 years ago when we had that 27% run. So, some of the concern you may hear out on the street is, well, we're losing all this money in real estate. Valuations are coming down, but correct me if I'm wrong, rent checks are still rolling in like
Absolutely.
normal.
And
So it's unrealized losses that are getting reported, but as far as us being able to make a pension payment, we're still getting all of the rent payments and have a lot of time on our hands to watch this turnaround.
It may be
Am I
real,
wrong?
it may
You're not
be
wrong.
real important as you're talking about it, to be specific about which sectors you're talking about. Because I don't think the real estate business is particularly uniform right now.
Right.
And that's really important from a perception standpoint.
Highly bifurcated, very property type specific, location specific, without a doubt. Yes,
I
sir.
mean, are we seeing just a very, very small number of transactions and then everybody's trying to mark to market based on those, depending on location, or what are we kind of seeing here?
Yeah, I would say the people that have embraced reality are marking to market. But I would say, at least in our portfolio, that most folks are embracing reality, with the exception of what I would refer to as our core funds, who are very reticent to embrace reality, and in most cases have not, for example, marked their office portfolios down 30-40%. I've read a number of articles about offices trading for 20% of what they traded for, 3 years ago, 80% below value. So it's happening. I would say the appraisers are still probably stuck in a few years back, and there's not enough maybe critical mass. There's maybe not a statistically significant sample set within a particular market to get comfortable talking about real price rationalization, but it's starting to happen. To John's point, managers are getting comfortable more and more with the interest rates. They're able to work their models. They're able to pencil out acceptable returns and have dialogue with the other side across the table, and they're able to transact. Again, I would say the news stories, 99.9% of them say that debt markets are closed. If you talk to our managers, they're originating debt all day long and financing deals. They're at higher LTV margins, but their debt's available for cash flowing assets. Banks are just, to my point, they're super tight. They're not lending on pro forma projections of rent growth. They're looking at what's in the market, what's out at the property level. But things are starting to sort of settle. Early stages, though, for sure.
So we've got a little more to go from.
I don't know about how much more downside. I mean, we'll get to Green Street's commercial property price index, which I show here, published as of February 6th, and in many cases for that last month, prices were flat. And in one case, multifamily was ticking back up. So there's some indication that things might be bouncing, maybe, and moving a little bit. The deceleration down towards the bottom has certainly slowed. But if I'm being honest, there may be some downside left. It's hard to know for sure. Certainly, with all the global macro going on, the Fed may hang out higher for longer. They may raise rates again for all we know, and that will put a real kink in the markets overall, without a doubt. But that's not my business, global macro. I pay attention, but forecasting it is a fool's errand. Any more questions? Otherwise, we'll bring you on to page 36. And again, we're within all of our policy ranges. The bottom table are cumulative commitments and cash flow through time. I will just let you know, this is illustrative of not only CAP, but our trust fund and state fund private investments. It's not just illustrative of pension, which is what the top of the slide says. So we'll make sure that's clear going forward. And then on the upper right, good news story here. So a couple things going on. Not that I would expect you guys to have committed any of this to memory, but here is a much more granular, for the first time, representation of our property type exposure. In the past, we had kind of looked at it more at a high level, manager by manager. With the recent implementation and full integration with the Solovis platform within State Street, we can really drill down to a property by property level. And as a result of that, I'm happy to say that Last quarter, our office exposure was 23%, which I was pretty happy with because we had been actively selling out of core funds, which have a big exposure to office. Well, guess what? We're at just under 11% office, which is amazingly good news from my perspective. And some of that's medical office, which is a steady performer. Some of that's life science. So just really good news there. We're all super happy that we have this level of detail and real transparency and data integrity now. And so we're pretty happy. I'm pretty tickled about this whole thing. Any questions?
Is the difference in data, is that from the vendor or is that you guys doing the work here?
It's not from the vendor. It's basically the difference between the vendor's ability to look at the data now versus in the past.
Okay, so it's kind of the software and your.
Yes,
Yeah,
that's
okay.
precisely correct. The data analytics that the vendor has brought to bear on our behalf.
That's what I was wondering.
That's right. If no more questions, we'll flip to page 37, which frankly we already touched on. Feels like we might be getting towards the bottom. Things are sort of shaking out and stabilizing. Happy to answer any questions. Otherwise, we'll just keep on moving.
So you're saying it's flat for the past month?
Just the past month. Yeah, I mean, you can still
Has it been
see.
negative in prior months?
Absolutely, yeah, and in fact, you can see if you move over a column, the past 12 months and then since the peak, I mean, all values are negative without a doubt. So this was literally the first month where I looked at this and went, oh my gosh, wow, that is a sea change from what has been happening in recent past. And this really Green Street sort of differentiates themselves. They look at real-time negotiations and pricing that's going on in the commercial real estate market between willing buyers and sellers. So it's frankly probably the single most accurate pricing index in commercial real estate that's out there. Most accurate and most timely. Moving on, next page is typically we would talk about new investments, but there are no new commitments to discuss. So unless there are any questions, we can move on to real assets. Moving on to real assets, we have the AUM, dollar value add, performance table. Again, some comments here, I won't read them to you, but I'll maybe just speak them out loud. US oil production's at all-time highs. Saudi maintains its cuts. We've seen, last quarter saw an uptick in construction and home sales, mostly new home sales. Existing home sales are still struggling. Aggregates, we've got a big aggregate position, or we're trying to get one. Aggregates, while volumes were down, prices were up double digits. In our rail car situation that John touched on earlier, I just read their quarterly letter last week, and their leasing renewal rates are at 95% renewal and at 30% above. So that's raging. Generally, it's good news. Oil has been sort of range bound. I think longer term, there's some pretty interesting fundamental supply and demand characteristics that are going to play out over the next few years, which in my view paints a very bullish case for oil. Any questions? Otherwise, we'll move on. Okay, similar page here. Again, we're within policy, cumulative commitments and cash flow through time for our private investments only. See our geographic diversification. Any questions? Page 41, I show crude through time, I show lumber through time. I've worked with operations to present these price graphs from Bloomberg. These are different from what I've, as far as what they look like and what I've showed historically. It's more congruent with the charts and fixed income, so wanted to standardize, and frankly, I think these look better. But look, oil's been range bound in the face of a Chinese economy that's struggling, the Saudi price cuts, tensions in the Middle East. We're just kind of hanging around the hoop. Lumber's back to pre-pandemic pricing. Any questions or any suggestions? Would you like to see other valuation metrics? Otherwise, I'll just keep sort of leaning on these, which are really the most sort of prevalent, but maybe I'll put aggregates or rail leasing rates in there at some point. Moving on to commitments, no new commitments since last we met. Happy to answer any questions Otherwise, I'll thank you for your time and attention. We'll hand it off to Aaron for macro attribution.
Oh, do you feel beat up or not?
No, I feel free. Look, I love what I do. I'm fortunate to be here and work with a bunch of smart people, and I pay attention to what's going on around the world, and I love the asset classes we're in. And the cool thing is we have a perpetual investment horizon, so I'm generally blind to volatility, and I just stay the course because we invest forever. And so I'm just looking for long-term accretive plays that will be value add to our portfolio construction through time. And so I'm confident that I'm doing that. Yeah,
Just curious,
please.
the chart of lumber prices.
Yeah.
It's fascinating, because if you go to Home Depot, what ain't come down?
There's a disconnect. I don't get it. I mean, I think, so this is more at the wholesale level versus the retail level. So that's probably mostly what's playing in. And I think, at least a little while ago, I haven't heard so much about this recently, but a lot of the distributors were piling up on supply because of what you saw there, and trying to get pricing and supply and volume while they had attractive pricing, and now they're just trying to push it out. And
Have you seen that kind of a pattern in other kind of consumer-oriented commodities?
To be fair and honest, no, I haven't. But that doesn't mean that same sort of behavioral price dynamic isn't occurring elsewhere.
Yeah, because you wonder what that says about inflation right there.
Yeah, you bet.
It's interesting.
Yep. Thanks for your time.
Thank you.
Thanks. You bet.
Thank you, Porter.
Good afternoon, Mr. Chair and members of the board. I'll be back on page 23 going over the macro attribution key takeaways. I'll be rather brief today, bear with me. Looking at strategic asset allocation first, I'd note that all benchmarks except for core fixed income made positive contributions to the pension policy neutral 4.6% return. Last quarter, this was about 5.7%, and this is the number on the page that's really going to change significantly from quarter to quarter. Moving down to tactical asset allocation, about 773 million equity asset classes were sold over the last year, and 378 million of fixed income and cash asset classes were bought, with the net number being our pension net cash need of roughly 400 million. In aggregate, the overweighting, underweighting of the asset classes relative to their benchmarks decreased the pensions portfolio return by 4 basis points. I'll just note that that's a typo error there on the page. It says increased, it should say decreased. With regards to style selection and manager selection, my comments have not changed much outside of the basis point changes from last quarter. So I'll probably leave it there unless there are specific questions from anyone. Thank you. Move it on to Jason.
All right, Jason, pressure's on. That was pretty brief.
I can be brief, but I think I'll just spend a half an hour. Given the glory of domestic equities over the last year, and you just about real estate, let's fixate on this for a while. Somebody push the button. No, good afternoon, Mr. Chairman, members of the board. I'm not going to belabor the point you've heard. How well domestic equity did, and you heard why. Surprisingly strong economy, stronger than expected consumer spending. The anticipation that the Fed was nearing the end of its interest rate hiking cycle. You've heard about the Magnificent Seven. Those 7 stocks averaged a return of over 100% last year, which is eye-popping. So no surprise that large caps outperformed small caps and growth outperformed value. As an example here, the Russell 1000 Growth, which is a large cap growth index, returned over 40%. And the Russell 1000 Value, which is a large cap value index, returned just over around 11%. Quite a disparity there. Moving to page 27, sorry, I didn't give you a page front, we had to flip back after you, but page 27, again, we are all indexed investments in domestic equities, so very little difference in sector weights. And as in past quarters, we have a modest overweight to small caps. There have been no changes to that exposure. No significant change to that exposure. Page 28. So the driver of returns really in 2023 for domestic equities was higher valuations, higher PEs. Earnings growth was, we'll call it just barely positive, slightly positive is what it looks like it'll end up being. With PE ratios still trading above their longer term averages, we see the impact of the Magnificent Seven and the concentration of the market in these largest stocks. The concentration is near an all-time high. And we see this evident in valuations as the largest stocks in S&P 500 trade at a significant premium to the rest of the market. For example, the top 10 stocks in S&P 500 at the end of last year traded at 27 times earnings versus approximately 17 times earnings for the rest of the stocks in S&P 500. Any questions about domestic equities? Moving to page 29, international equities. Strong returns for international equities. It doesn't look quite as impressive when compared to returns of US equities, but when you have close to a quarter of the US stock index, close to doubling, that's hard for international stocks to keep up with. It's hard for developed markets to keep up with, and it's especially hard for emerging markets to keep up with as emerging markets underperform developed. Emerging markets continues to have the drag from weak Chinese returns. In the strong market of 2023, Chinese stocks are actually down. As Becky mentioned, the dollar, we've been in a long period of dollar strength, and last year, a slightly weaker dollar that Becky referred to, which was a small boost to international stock returns when measured in US dollars. A few differences though in the international market. Unlike in the United States where large cap growth dominated, value outperformed growth in international markets, and small caps traded roughly in line with large caps. Page 30. As in domestic equities, we do have a small overweight to small cap. You can see in the bottom left-hand corner that no significant changes to that exposure. In the top left, we do have a very small overweight to EM. And again, as a reminder, this is the aggregate of our managers' exposures. It's not something that we as a team actively manage. See the sector exposures in the upper right hand, that's the same story. These are the aggregate exposures of our managers. In the bottom right hand corner, you see the split between active and passive management. We did increase our exposure to active last year. Prior to that change, we were roughly equal split, 50-50 split in active versus passive.
I have a question, Jason, on that developed versus emerging. Is there a significant difference between returns between those classes?
Huge. If you go back 3 years, it's big. And if you go 3 years, China versus the rest of the world, it's even bigger. So it's been notable difference last 3 years in terms of the difference in returns between developed and the US and international too. So.
When you talk to our Chinese managers, or sorry, Dan, can you give us a flavor of what they're telling you?
I think the short answer would be there are opportunities. A lot of Chinese equities have been painted with a broad brush that have led to very attractive valuations, but there are still some headwinds. They have a property bubble that burst, consumers that aren't spending, unfavorable demographics, so some of the headwinds. So it's not super clear, but opportunities, but still some risk and some headwinds that have to be overcome.
Thank you.
So if I may, we don't have any Chinese managers.
No.
Well,
It would just be international managers that have some
yeah.
Chinese exposure of some sort or another. And it's not that big a weight overall relative to our peers, most of our peers, in that particular sector. But, you know, obviously it's an area that's got beaten up. You know, broad strokes, we talked a little bit about, you know, we've got emerging market exposure versus some of our peers that may not have that type of thing. You know, we've talked about this a number of times. At the end of the day, I can't come up with a good investment case as to why I would exclude big chunks of the market, right? And so when we look at kind of that ACWI exposure, ACWI ex-US exposure, I mean, that's the investable market. And so I understand that people have, you know, chosen to exclude that for a variety of reasons, but I can't quite get there, you know, we can't quite get there in terms of, you know, why would we remove that? And if you look at very long history, there's been times when it does very well, right? I mean, you had a extended period of time where China was roaring and everybody was okay with it at that point in time and made good returns. I'm not making a prediction as to whether or not that, you know, does or doesn't continue, but I mean, that's kind of the point, and I guess kind of our broader philosophy here is we tend to not want to make those kinds of bets where, you know, we're coming up with rationale that is not based in some kind of, you know, investment reality, I guess, if you will. So.
Well, I think that's a good answer in that, you know, when we're investing long-term, you can't get too involved in tactical things with short periods of time. That makes sense to me.
I have one other question, if I may. So, okay, given the disparity between returns from emerging markets versus developed markets here, and you got a 15% return, so that means the developed markets are returning a lot higher than that.
Yeah, so the, let's see, last year, developed, the numbers right, returned 17.5, EM was 11.7-ish. 3 years develops up 4.6 and EM's down 5-ish.
Okay.
Moving to page 31. Similar to in the United States, PE ratios rose for international equities last year, but unlike in the United States, valuations for international equities closer to in line with their longer-term averages, and has been the case for a while. International stocks still trade at a discount to U.S. equities, and that discount is about as large as we've ever seen. Any questions about international equities? Moving to page 32, non-core fixed income. As with the other asset classes I get to talk about, strong returns for non-core fixed income in 2023. Asset class outperformed core fixed income by a large margin, which is one of the primary goals for the asset class. U.S. high yield and emerging market debt were with the strongest areas in the asset class. Preferreds had underperformed in 2023 due to the pressure on the banking sector that we saw in early 2023. Preferreds have since rebounded and have been the strongest performer so far this fiscal year. And as we discussed too, in terms of relative performance, our high yield managers tend to have a more conservative bias, and that was a headwind in a strong up market like 2023, where the lowest quality segment of the high yield market outperformed. And two, since high yield was the top performer among the strategies within non-core fixed income, the exposure to these other strategies was a drag on returns relative to the benchmark, even though they were, even though we still had strong returns in say EMD, that at least versus the asset class benchmark, exposure to those strategies was a negative. Turn to page 33. So our exposure to strategies outside US high yield leads to difference in sector exposures. Again, the asset class benchmark is the US high yield benchmark. So you see some notable changes in sectors. For example, preferreds, as we've talked about before, have very high exposure to financials. Emerging market debt, which are all foreign government bonds, there are none of that in the US high yield index. And two, as you see in the upper right, difference in ratings exposures. Essentially all of the asset class exposure is in investment, or is in below investment grade. Most of the preferred index is in investment grade. Roughly 75% of that benchmark is investment grade. Emerging market debt has about 60% in investment grade. So that's where you get some of those differences in ratings exposures. Page 34. With the strong performance of high yield in 2023, spreads have compressed. It's hard to tell from the scale in the graph, but spreads are over 500 basis points briefly in 2023, and ended the year about 200 basis points tighter than that. I think in recent board meetings, recent updates, I described high yield spreads as being in a normal range and not screamingly overvalued or indicating distressed. With the spread compression, I would say we're closer to the tighter end. We're not at all-time lows, we're not at extremely tight levels, but we are towards the tighter end of spreads relative to where they've been in history. But part of the difference today from some of the parts of the last decade is, so these spreads are in addition to US Treasury yields. And if Treasury yields higher, absolute yields are higher. So absolute yields for high yield now in excess of 7%. We did actually dip a few years ago below 4% for total yield for high yield. Not terribly attractive, but trading today above 7%, which is a much more reasonable level. That's all I have for non-core fixed income. I'm glad to answer any questions.
Thank you.
Good afternoon, Mr. Chairman, members of the board. Thomas Winkler, Director of Private Investments, just giving you a quick update on the private investments portfolio on page 43, since we skipped the 48 up front, right? So slide 43, remember we're in cap only, so not in any of the other pools. Not a whole lot of changes from one quarter to the next. Just like to point out 2.5 billion here in total assets. That is up almost 80 million since last quarter, so that's really the big change on this page. As you recall, this is a very long dated asset class, so we do see some ups and downs on the short-term performance. So clearly behind the benchmark on the 1 year here, like you just heard Jason talk about the very strong public markets returns. Our benchmark is a public market return, public market benchmark, so we will always be either way ahead or way behind that one. Just pointing out on the 10-year and even 5-year number, well ahead of our benchmark and performance very strong. The underperformance on the 1 year is really within expected margins. There are no questions on that particular slide. I'll move on to page 44. Characteristics of the portfolio. Again, not a whole lot of dramatic changes here. You see in the top left, we are well within the ranges of buyout, venture, and credit. Managing through that. The top right-hand chart, again, not a lot of changes here. It is an equity-heavy portfolio, so we're trying to grow the portfolio. We do have about 22-23% in credit. That is not unexpected. That is by design, and we'll probably manage around about a quarter private credit asset class. The international domestic breakdown, again, no major changes here since last time we spoke, and it's a US-heavy portfolio by design. Any questions on that particular page? Seeing none, then I'll move on to page 45. our valuation slide, or pricing, whatever you want to call it. And if you recall some of the comments I made in the past, that we expect the calendar year 2023 to come in somewhat close or maybe even slightly ahead of the pre-pandemic years in terms of deal value, money put to work, and number of deals. That's exactly what you see in the chart here. That 2023 bar is effectively in line with the pre-pandemic years, even slightly ahead on the deal count. That is not unexpected, as overall deal size in the private markets have come down pretty significantly. That is again linked to the interest rate movements and the cost of capital for the managers. They've started to pivot more towards smaller deals that are easier digestible, easier to finance. So we see a lot more add-on activity and smaller deals being done in that buyout market. On the right-hand side chart, again, talked about this last quarter, interest rates have certainly an impact here on the leverage levels. Those are those dark bars. You see that 4.9 debt ratio that has come down pretty significantly below a very, very long-term average. Again, not unexpected. But the point I wanted to make here on the overall valuations, or the price managers pay for these companies in terms of EBITDA, is that bluish line. You see that has dipped quite significantly since the 21 height of the pandemic, if you will. Just the point I wanted to make here, that's another reason why we're trying to serially commit throughout every single calendar year. For one, we can't predict these pricing dips. And second point, all the commitments that we made in 22 and 23, recall they have like investment periods 4 or 5 years. So those managers are now able to take advantage of these lower prices in companies they're hopefully going to buy in the next fund. Any questions on those particular?
Can I go
Mark, go ahead.
on slide 44? Okay, so buyout is a bigger share of private investment. So can you describe what is in the buyout bucket here?
Just from an asset class perspective.
Are they buying companies? Are they buying other? Okay.
Yeah, so the primary goal of a buyout strategy would be to own or to purchase a majority stake in a privately held company, then turn that into a larger company, hopefully, and then sell it to the next either private equity owner or a strategic in the same segment, in the same marketplace. But yeah, most of the managers that we invest in will go in and purchase a majority of a smaller private company.
So they're looking to turn it over fairly quickly, or?
The usually holding period is anywhere from, oh God, on the very short end, I would say 2 to 3 years, and on the long end, 6 to 8 potentially, depending on how the strategic plan works out.
Okay.
If there's a pandemic in the middle of it, it might be 8 years.
Yeah. Right, thanks.
Then no other questions. I'll move on to page 46 quickly, just overview of our fiscal year-to-date commitments. You heard us talk about the first 3 in gray. We have made 2 new commitments, which brings us to roughly $305 million committed for the fiscal year-to-date. 4 months to go, I believe. We have 2 more deals in the pipeline, which put us right in the middle of that 400 to 500 pacing range that we always present to you. And I'll actually have my co-worker Ian talking to you a little bit about Apiary and Blue Sage, our most recent commitments.
Okay, thanks, Thomas. Good afternoon, everybody. Here to present our 2 commitments. So first one is Apiary. This is the first one on November 24th. Last year, we subscribed to 40 million British pounds, which is roughly $50 million US dollars. They're headquartered in London. This is a new relationship for us. During our mapping exercise of the UK market last year, we uncovered them and diligenced them over the course of the year. Apiary buys small companies exclusively in the UK and Ireland. They are more of a generalist as it comes to their sectors as a plan. However, they do focus mostly on services businesses. So think businesses that don't have heavy CapEx spend, like accounting, training, travel management, or childcare businesses. Nothing heavy like manufacturing or something like that. We like Apiary because of the reputation of the founding general partner. So Mark Salter, he was a senior investing partner at a larger mid-market firm in the UK, a very successful partner. Essentially, he was the rainmaker at that firm. And as they got bigger and started doing bigger and bigger deals, he spun out to start his own firm that exclusively focused on small cap buyouts. So that's Apiary. I'm excited about this commitment. Happy to go into any more questions about them. Okay. Seeing none, I can move on to our second investment. This is Blue Sage Fund 4. This is a re-up for us. We subscribed in January with a $60 million commitment. Blue Sage is headquartered in Austin, Texas, and they buy small cap companies, mostly in Texas, but they'll go to the Midwest as well. They buy from founders, and they specialize in niche manufacturing, environmental solutions, and business services. They source and buy investments very similar to how Apiary will do that in the UK, avoiding competitive banking processes and buying straight from the founders. We like Blue Sage because they are buying these small companies from founders. This allows them to buy them cheaper, professionalize the business, get them ready for their next stage of growth, and then sell them on. There's multiple exit sources, a lot of mid-market PE capital that's been raised that will buy these companies. And then the other reason we really like them is they do have that sector focus. They focus on those 3 sectors I mentioned, and they've been really successful there. And this is really just a continuation of that same strategy. So very happy to re-up with Blue Sage.
I noticed, and I like to see when we re-up somebody with a good IRR.
Yeah.
That's tremendous. How do they do that, or just in general, do you know?
Yeah, so we've got 20.3. Well, they've had, so that's their fund 3. They haven't exited any of those businesses yet, but they have marked up several. So that's a 2018 vintage fund. We were actually just there in Austin, Texas last week and met with the team. And that was one of the first things we went over was what is in the pipeline to sell. They've been very conservative with their marks, which they should be. But as those companies sell this year, that's when we'll realize the returns. So right now, this is all paper gains, but from what we're hearing and seeing from being on site, we've got some pretty spectacular exits this year. So they've done really well.
Good.
Okay, that's all for me. Okay, thanks.
Thank you.
And then John Roscoe.
The short guy.
Couldn't get that airline to delay you a little bit more.
Right. Well, I wouldn't want to rob you guys of the opportunity. If it pleases the chair, if we can look at slide 47. Encouraged to see good performance after a couple of years of negative performance in core fixed income. Performance very close to the benchmark across the portfolios. The large driver of the performance was the yield, underlying yield of the securities. And, you know, that seems like kind of an obvious statement. That's our core expectation is returns or yields, but it's been since 2017 where the yields were not totally overwhelmed by various fluctuations in interest rates. So hopefully we've turned the corner there. Can expect returns again mirroring yields going forward. So the yield for the pension fund started the year at about 478. You can see the return a little bit higher than that. So a couple of tailwinds there, the major one being at corporate option adjusted spreads contracted about 33 basis points, and that added about 42 basis points of additional return. That also explains the majority of the difference in returns between the pension fund and the trust fund. You'll recall, or if you don't recall, you can see it on slide 49 that the contribution to duration from the, for the pension fund from corporates is about 71% of the index. Just a handshake deal between John and I that the pension fund will always be a little bit light credit because we believe that the risk is better taken in equities than in corporates. That was particularly light, but that was driven just by some cash flows at the very end of the year. Other than that, good relative performance to the index. I would just say happy with the yields going forward. It feels like maybe we've turned a corner. Returns will be supported by yield. If I could paraphrase a more eloquent man, I might say that the yields will be the golden handcuffs of returns going forward.
Very good.
Any questions?
I'll certainly defend you if you need.
I might.
You can tell the compensation conversation's far away at this point. It feels comfortable.
Thank you.
Oops. Oh, there's that red light. So is that it, Dan? Is we anything else?
That is it. To do for next time, Doug and I'll have we'll have a procedure on bank reviews within the loan portfolio. And we'll have a $15 million line of credit available for your review and approval for the DNRC within the InterCap program. And obviously, I will keep you up to speed on any developments within the audit or the cost savings fee reduction paths.
Do you see anything going immediate before next meeting on a project in Deer Lodge, or is that just chugging along?
I think the project in Deer Lodge, we have to acquire the blueprints, the engineering, mechanical, structural, plumbing, electrical, and then actually get through the subdivision process with the city of Deer Lodge. That's ongoing. Construction wise, I don't think we'll have anything to update you on before April, unless the weather really doesn't, or unless we have a really bad winter. Don't see that moving. The only thing that might come up, we may need a special meeting on some policies, but we can do those over Zoom if there's a separate account that comes up at some point.
On this project?
No, not on this project, on the general. There's a lot of moving pieces within the state on the debt-free account and where those are at. If we can wait till the April meeting, because that's when we typically do our policy review anyway, we will. Otherwise, I don't see, loan-wise, there isn't anything that we'll need sort of a quick review on. Can all wait till April.
Okay, so it's April 10th, right?
April 10th, yep.
Another one-day meeting.
Mm-hmm.
Anything else for Dan? Okay, well, I think we accomplished a lot today. Went smooth, so thank you. Want you to, in particular, thank all the staff. I'm quite impressed with each and every one of them. And so with that, I'll call the meeting adjourned.